Hi everybody, and thank you for joining us today on this webinar on Buying a Dental Practice, your complete guide to getting it right. So I'm Tom Slevin, and joining me today is Matt Norton, accountant and client service director at DJH. And we're also joined by Hughie Marr, legal director at Brabner's Independent Law. So for those that don't know, DJH, we're a specialist dental accountants firm trusted by over 2,000 dental professionals across the UK. And we offer expert advice on a wide range of services, including accountancy, tax, capital allowances, buying and selling practices. Brabner's is a long-established independent law firm with a dedicated dental team. Brabner specialise in practice sales and acquisitions, CQC regulatory matters, employment, property, and handle many dental transactions each year. And we're both proud members of NASDAQ and ASPD. So before I hand you over to Matt and Hughie, we'll just go through the transaction roadmap, which we'll go into in more detail in the webinar. So the first part of buying a practice is obviously finding a practice. So looking for the ideal practice to purchase. Once you've got that, we'll go through what you need to do to determine whether the practice is worth buying, and then you make an offer. You'll then do due diligence, so that'll be legal due diligence, property due diligence, financial due diligence. There'll be CQ registration. There'll then be negotiating, so that's negotiations between the buyer and the seller, making sure that you're both happy with the purchase and of the practice. At the end, there'll be an exchange of contracts, and then you complete, and we'll go over some post-completion matters as well. So what I'll do, I'll now hand you over to my colleague, Matt.
Thanks, Tom. So I'm going to start us off really the start of the process really, and that's looking for the type of practice that you would want to buy and ultimately run. So this side of things really, I always kind of compare it to buying a house, because if you're going to buy a house, you'd have a good idea of kind of what you want to buy, what you'd be looking at in the market, and buying a dental practice is pretty similar there. Yeah, there's a big difference between looking at a dental practice with maybe one or two surgeries that's fully private to maybe a practice that has 5 or 6 surgeries with a mixture of NHS, patient plan schemes, maybe cosmetic dentistry in there as well. So they are very different types of practices. So it's really important really to sit down and just really think about kind of what you want out of the practice really. You know, moving forward, are you looking to be mostly clinically facing? And maybe, you know, a small practice with 1 or 2 surgeries would do the job in that case. Are you looking to purchase something that may be associate-led? I'll go into a bit more about what that term means a bit later on, but associate-led is generally where the practice is being run majority by associates. In that sort of circumstance, really, you're probably looking at something with probably 3+ surgeries. Particularly in the future, if this is going to be maybe an initial purchase with a view to grow maybe a mini corporate and a mini group, again, you'd probably want something with at least 3 surgeries where associates would come in and run the practice at a level that would mean that you could maybe go and work elsewhere, or maybe to look at sort of 2 or 3 purchases down the line. Really important as well to consider ownership structure. And this is an area I definitely recommend speaking to an accountant like ourselves about. Usual structures we see are buying the practice as a sole trader, so in your personal name as an asset sale. If you're looking to make a purchase alongside maybe a colleague, would you be running that as a partnership or as a limited company? Again, very different structures. Both have their sort of plus points and minus points, really, if you like. I would probably say these days, particularly with practices that are majority or fully private, most clients we see now are kind of going down the limited company route. Usually gives a bit more kind of protection to the individual, helps with kind of long-term planning and things like that. But that's something really that would feed on from, you know, what are you actually looking to achieve over the next sort of, you know, 2 to sort of 10 years and maybe longer. You know, if you're looking to kind of build, like I said, a mini group or a corporate, a limited company structure would probably work better in that kind of circumstance. If you're just buying a very small practice, maybe 1 or 2 surgeries, particularly with NHS, it might be easier just to run that as a sort of sole trader business that has a tax burden might not be too bad for something like that. But again, that's at the time I'd really want to be advising you to speak to an accountant about and getting bespoke advice for your circumstances. And as well, looking at sort of your priorities really when it comes to buying a practice. Ultimately, you're looking to buy a business. Are you looking to relocate? Are you looking to buy something in the local area? No, ultimately, this decision of buying a dental practice is as much a lifestyle choice as it is a business choice. If you're going to want to kind of move to more rural areas to buy a practice, because that's a lifestyle choice, you may have to also think about areas such as recruitment, which may be more difficult in more rural areas. Or if you're looking to buy a city centre practice, that does come with the issue of probably end up paying a bit of a premium, because like most things in life, if you're looking for a premium city centre location, that's probably going to come at a cost to you as the buyer. And as well, what are you looking to bring to the table as well? Are you looking to just come in the door and just carry on and tick over and take over from the previous principal? Do you have a bespoke skill set? Are you a specialist and you can bring some specialist work into the practice and really look to increase the turnover that way? So just looking at that kind of side of things, really. And finally, again, a little bit like buying a house, this one, what are you looking at in terms of the practice itself? Are you looking for something at the turnkey property where you can literally walk in the door? It's got the new cabinetry, it's got the nice posh reception, it's got the dental chairs all relatively new. Or are you looking to maybe get a bit of a bargain, pay a little bit less up front with a view to maybe spending a little bit and converting an old building into a dental practice? Needs a little bit more attention, will ultimately take a little bit more time and cost to convert that, or to bring it up to the relevant standard you want. And again, a bit like location, if you're looking at buying a practice that's all bells and whistles and all been done up and kitted out already, you are going to be probably paying a premium for doing so. And at this point in the search and the process really as well, I think one piece of advice I'd like to give is just to go out there and probably sign up with some of the selling agents. They can put you in touch with the right people. They can let you know when new practices come on the market. They can also obviously send you and help you go and visit practices. And again, a bit like buying a house again, go and visit practices, get a feel for what's out there, what your money's going to buy you, and what kind of thing, get a feel for what's going to be right for you ultimately. Now I'm just going to hand over to Huey for the next section.
Thank you. Yeah, so my name's Huey. I'm a solicitor and I've been helping dentists buy and sell dental practices since 2007. And there's been so much change. There's still the buying and the selling, but the regulatory requirements on a transaction are just mind-numbing these days. And I've acted for individual buyers and sellers to larger corporates like Roderick's. But ultimately, the parties just want to get from A to B as painlessly as possible. But as a first-time buyer or somebody who's coming into this as a new process, there is so much to navigate. And it's probably one of the biggest decisions that you're going to make in your life. Much like Matt says, buying a home, is this going to be your forever home? Is this going to be your forever practice? Is your plan to buy and build and then sell? But the good news is that, DJH and, Brabner's, I know from working with DJH, we're a really supportive group. I personally like to handhold buyers right through the transaction and just try and take as much of the burden away from them. So, I can't control. Hold on, I can't control the slides for some odd reason. There we go. So, at the search and offer stage, some of the key things to consider are the solicitors, because where you have this challenge of expertise versus affordability, and quotes for legal services range massively. But what I must say is it really does depend on how much you can afford, and that's a real key player in making your decision. But also, my bit of advice would be, if you buy cheap, you buy twice. And I know so many buyers who have come to the market new, not knowing what they're doing and thinking, I'm just going to go for the cheapest option, because actually I understand that you've got this huge amount to pay at the end of the transaction for this business. But, I know so many who have been stung and gone, oh, well, actually the fees have increased so much because, the solicitor didn't know what they were doing. So just bear that in mind when you are instructing a solicitor. One of the first documents that you'll see is the memorandum of sale. And that is just the skeleton of the deal. And I'm going to talk you through some of the red flags and pitfalls to look through for that. So it's set out as not being legally binding, but like I say, it is the bare bones of the deal. And in there, you need to pay special attention to what you're buying, who the parties are, and is this clear? Now, as Matt had said, knowing what structure you're going to acquire as is really key, because the heads of terms might say something like, Dr. Matt Norton is going to buy, but actually it's going to be his limited company, or it might be like Dr. Tom Slevin is selling, but actually he's selling Tom Slevin Limited, the shares of the limited company. So make sure you know from the selling agent or from the seller directly exactly what you are buying. Okay. The structure is really important as well, because if you're applying for bank funding, I've come across matters which have been delayed for 1-2 months because the buyer initially thought they would be buying in their own name, but actually following advice and possibly going to the accountant too late, they've decided to buy in the limited company, at which point, the funding application has been made in the name of a person, an individual, rather than a limited company. So that can cause some big delays. Another thing to look out for in the memorandum of sale is the price and apportionment. And a lot of the times the apportionment, which is the split between the goodwill, equipment and the property on an asset deal, is just indicative. And make sure you go to your accountant early doors for some guidance on that, because some sellers will get it into their heads that that is the apportionment and they won't budge from it. Okay. The practice price is also set out in the memorandum of sale, and that's on the assumption usually that the practice is hitting a particular revenue from the last 12 months, and that it doesn't dip below that percentage of the marketed turnover. Usually that's between 90 to 95%. So just check what it says in the memorandum of sale. And if you're unsure, run it by your accountant or run it by your legal team, who'll be able to give you some guidance on it. Now, during the transaction, as I've seen a lot of times, sometimes the seller will kind of like take their foot off the gas almost, and you will see a dip in revenue. Now, if the transaction overruns, sometimes transactions can take 6 to 12 months if there are difficulties, and revenue does dip. Don't be afraid to go back to the negotiating table and say, well, actually, this was on the assumption that the revenue would be maintained. So actually, at this point, I want a price chip. It will also set out how the property is going to be transferred. So are you buying the freehold property? Are you taking on the current lease that the seller is occupying the property under? Or is a new lease going to be granted to you? So do check those points really carefully. Some other things to look out for is if there's any finance on equipment and what's happening with those. So what I tell my buying clients is actually, if there is finance, if there is equipment on finance, the valuation of the practice is often done on the basis that all of the equipment is going to be included in the sale. Now, I know things like CBT scanners or iTero scanner, handheld scanners, they can be really, really expensive. So why pay for that? Make sure it's on the seller to pay off any existing finance, so you get to enjoy the equipment free of finance. Look out for whether there's any of the seller's dependents as employees, and if there are, make the seller responsible for redundancy, or accepting that they will protect you from any claims from their dependents. And if the seller is staying on after completion, is this a key point for your business plan? Do you absolutely need the seller to stay on working for you following completion? If it is, make it clear in the heads of terms. That's one of your considerations. And also think about whether any of the purchase price needs to be held back as deferred consideration to keep the seller on the hook. And if that's the case, what targets perhaps does the seller need to reach before you pay out that deferred consideration? So like I say, the heads of terms shapes the deal. It can be difficult to change any of those terms that have been agreed in heads of terms during the course of the deal. So, whilst I say it's not legally binding, it's very difficult to kind of change the course of that deal once you've actually thrashed those key points out. And because the heads of terms are often prepared on the sell side, perhaps by the agent, the heads of terms do tend to be biased. And I've seen all sorts in there where you go, oof, I wouldn't have agreed to that, but unfortunately the buyer's already signed up to the heads of terms. Other things to look out for is a commitment fee from the agent. Some will ask for up to £500 just to consider you as a buyer. And some will even say, actually, we want you to have to pay the commission. And this crops up now and again. The majority of the times, a selling agent, a bit like buying a house, the commission will be charged to the seller. But there are some agents who will make it the buyer's obligation, particularly if it's a very attractive practice, or if you sign up as what they call a platinum buyer, and the commission can actually add a significant amount onto your practice purchase. I've seen commission ranging from 3 to 5%. Some buyers will pay up to 5% of the asking price just to secure that deal. Whether or not that's for you is down to personal circumstances and whether you can afford it. But speak to your bank about serviceability of a loan if you do have to factor in paying a further 5% for commission. The agent will also be interested to see whether you have funding to secure to find out whether you are a good buyer, because a buyer who is prepared will come to the table with funding in principle, and usually there will be a deadline set to provide evidence of funding, and that's about 12 weeks. On the flip side, you will be granted exclusivity. So this means that you are entering into the heads of terms knowing that the seller won't start dealing with anybody else, and you can avoid things called contract races, where you're racing against another buyer, in which case your negotiating position is really weakened. And usually under the heads of terms, you'll be granted exclusivity for about 6 months. So the difference is then with a deposit agreement. Deposit agreements are much riskier. The memorandum of sale is the skeleton of the deal, and yes, you may be required to buy to pay for the seller's agent's commission, but that's quite rare. A deposit agreement actually is legally binding. If you are ever issued with a deposit agreement, make sure you are instructing solicitors on that, because there are significant risks to you. Again, it's a document prepared by the sell side, so look for bias in there, but provided that you instruct solicitors, it can be negotiated. And the deposit is usually 1% of the asking price. But within the deposit agreement, make sure that there are provisions there for a buyer to be able to get out of that agreement and be able to get your deposit back. Things such as timescales can be set in there, and the seller may say, well, it's 6 months from signing up to the deposit agreement and completion, and if you don't complete with me by that 6-month period, then I take your deposit. Now, that's not always fair, because I've seen lots of sellers who have struggled with gathering information on the practice, or there's delays caused elsewhere, which is out of the buyer's control. And it's not necessarily fair then in those circumstances that the buyer would lose their interest. So get that checked out carefully. And what about, for example, when you start carrying out investigations on the business? So when you're buying a business, you want to make sure that it is as it seems, so all of the equipment's maintained. You don't want to have anything coming out of the woodwork that would actually deter you as a buyer. In the circumstances where you find something that would be off-putting, and actually if the bank would actually then refuse to lend you money on account of information discovered during your investigations, how do you then get out of that deposit agreement? Well, if you haven't had your solicitor check this deposit agreement carefully, then you are putting your 1% deposits at risk. The other thing to look out for, both in a memorandum of sale and a deposit agreement, is whether there's something called a costs indemnity. Our costs indemnity can be applied to either the seller or the buyer, or both. And it basically means if one side pulls out for whatever reason, then that side who has withdrawn will pay the other party's costs, and it's usually capped. Now, again, you don't want to agree to pay for costs no matter what, particularly again, if you find something wrong with a practice that makes you change your mind. So if there is a costs indemnity, it's really, really careful to check those provisions really carefully. So takeaways on that on this slide is, what are you buying? Does the heads of terms set this out? And go back to the negotiating table if it doesn't. And funding, have you actually got this in place? And do you actually need to buy some time to get your funding offer in principle before you sign up to the heads of terms, particularly if there's a risk of you having to pay a costs indemnity or a deposit? Okay. So then we go back to Matt.
Thanks, Hughie. So I'm just going to pick up and looking at the kind of valuation side of things. So in my first section, we were looking at kind of, right, let's go and find the practice that we want. What kind of practices are we looking at? Okay, we found something. We'll get a valuation from the selling agents. What are the next steps? So the next steps really are understanding that valuation. To some people, a valuation without knowing much background to it doesn't mean very much. So usually the practice will be based on or valued on a multiple of what we call EBITDA. So historically, the valuation was done on a percentage of turnover, but on pretty much all deals these days, you'll be looking at something called EBITDA. And EBITDA is simply earnings before interest, tax, depreciation, and amortization. So effectively, what we're trying to do there is we're trying to look at the actual profit of the business, but stripping out tax, depreciation, amortization. There's certain aspects that could kind of swing it. So, for example, if the practice has not been incorporated very long, they might have a big amount of amortization in their profit and loss account. That could swing the numbers completely. So by stripping out certain things like that, it just means that you can compare apples with apples and different practices against different practices. Commonly, there'll be two ways to do it. It's looking at the EBITDA and the valuation on a principal-led model. What I mean by that is whereby the practice is majority run by a principal. So you would be probably likely going in and running it on a similar basis. So obviously in there, you would have generally less of associate costs because the principal's doing maybe the lion's share of the work. And as a multiple of EBITDA for a principal-led model, you'd be looking maybe 3 or 4 times the EBITDA. More commonly, though, most selling agents will value on the associate-led model. And this is effectively adjusted for the existing principal. So if you were to go in there and run it purely using associates, what would that look like? And obviously, that drives a lot of the sort of corporate deals and things like that. So generally speaking, multiples are higher, usually sort of 7 to 9 times the EBITDA value on an associate-led basis. But that profit has been adjusted for the fact that the principal will no longer be there and they are being replaced with an associate. So the actual profit would obviously be a little bit lower. But as I said, practices that can be run as associate-led practices are much more appealing to the mini corporates and corporates of the world. Therefore, the valuation do tend to be a little bit higher than that. So quite often, if you are looking for that first practice or a small practice, it'd probably make more sense to look at that valuation on a kind of principal-led basis if that's what you were to go in and carry on doing. Just be aware as well that as much as we can sit here today and talk about kind of the values and how it's worked in terms of multiples, other adjustments will be made to the numbers as well. So as I said there, you've got earnings before interest, tax, depreciation, amortization is the EBITDA model. But commonly as well, when the valuations are done, the valuers and the selling agents will have to strip out certain things. There might be things in there that sort of anomalies, if you like. So if someone is selling a practice currently, they may have had to pay out a few £1,000 in maybe accountancy or legal fees to get a bit of a valuation and get a bit of initial work done. The selling agent then might strip out them anomalies and say, okay, well, the extra £5,000 in legal costs are a one-off, therefore we're going to strip them out. So that is quite normal, but make sure the right things are being stripped out as well. Quite commonly with clients, I'll do what I call a sort of buyer's appraisal, if you like. And that's where I'll kind of review the valuation based on the sales prospectus and just check it actually looks reasonable. And there's no sort of nasty surprises in there. They haven't pulled out anything. they shouldn't be pulling out. It's fair enough. A practice may have had significant repairs one year, and okay, the valuation may look to standardise that and say, okay, well, over 3 years, the average repairs of the practice are £3,000. That would seem reasonable. If for 1 year, then repairs were £10,000–12,000, it would seem reasonable to put that down to £3,000. It would seem unreasonable to strip that out completely and have nothing in there. So it's just understanding the numbers a little bit and just seeing how they're tweaked. And again, as accountants who specialise with dentists and these kind of deals, I would strongly recommend you speak to ourselves and get the once over and that buyer's appraisal, looking at that sort of thing really, and making sure that valuation is a fair one. And as Hugh's mentioned as well, it's important to be clear on what you're actually buying. There is a big difference between an asset sale, whereby you are just generally buying the goodwill and the equipment of a practice, and a share sale or share purchase, where you're actually inheriting the history of the company and you're purchasing the shares. For all intents and purposes, on a share purchase, that business is just carrying on. Even though it's under new ownership with yourselves, the business is carried on and you're inheriting the history to it. So generally speaking, I'm sure Hughie will talk about this later on, there's a lot more due diligence to do on them kind of deals. One thing Hughie mentioned as well was looking at them initial numbers and being clear on an asset sale, what the goodwill and the equipment split is. And one real reason to make sure you're clear on that up front is that as the buyer, ideally you want the equipment side split to be as high as possible. And the reason for that is that you'll be able to claim what's called capital allowances or tax relief on the equipment on day one, once you start trading. Whereas when you buy the goodwill, you won't be able to claim any tax relief against that until you sell the practice, years and years down the line. Contrary to that, the seller themselves will want the opposite. They'll want the goodwill figure to be as high as possible and the equipment figure to be as low as possible, because they'll be looking to claim business asset disposal relief properly, and they'll get that a lower rate on the goodwill. So they want the goodwill to be higher. But as a buyer, you want the equipment to be higher. Quite often as well, it's kind of how do you measure the equipment? On average, I would say probably most deals I see tend to put a bit of an average to it. Hugh mentioned there's situations where you might have a new scanner or some fancy equipment, and by all means make sure that's valued separately. As an average, you're probably looking between maybe £5,000 to £10,000 per surgery for the equipment, would probably say as about average. Also, when you're buying on a share purchase of a practice, quite commonly it'll be classed as what's called cash-free, debt-free basis. So again, Hughie mentioned there about any finance agreements that need to be made clear in them initial terms, but also as well, it's usually in there that them finance agreements will be paid off and settled once the new buyer takes over as well. I touched a little bit on this earlier on as well, when you're at that initial looking around and kind of viewing stage. Make sure the equipment condition is in a good way. If you're going to have to go in there and replace all the dental chairs, for example, then that should be accounted for in the valuation of what you're paying for it. It's going to cost you a lot of money potentially to rip out old kit and put in new equipment. So the refurb cost really can be a good way to kind of leverage and get a reduction in the valuation of the practice. Again, I'll make the comparison to buying a house. If you're going to go into an old house that required a lot of work, you would expect to pay a bit less because you're going to have to do that work. On the whole, the seller will have to accept if they're selling the practice in a poor state, they will have to take a bit of a hit in the valuation terms as well. So that is quite normal. And ultimately as well, why does this matter? Well, ultimately, the valuation affects how much you're going to pay for it and how much you're going to borrow and how much you're going to be paying each month for any potential borrowings from the bank. And also it will be putting a bit of a stranglehold on that cash flow when you're running the practice as well. And talking about cash flow as well, it's been important to be clear on the difference between cash flow and profit. Profit is very much on paper. It doesn't include any capital repayments of your loans. It doesn't include your tax liabilities, and it doesn't include the drawings you take out of the business to live off, generally speaking. Therefore, in a lot of circumstances, probably one of the biggest bits of advice that I'll say to a client is that we can look at a valuation for you and do a bit of work on that and say, okay, that looks like a fair value, or that value looks a bit high. I'd recommend maybe going at a lower value and making a lower offer. But actually, the valuation could be right, or it could be, there or thereabouts. But ultimately, the most important thing to look at is the cash flow side of things, because it doesn't matter if you're paying a fair price or not. Ultimately, if after you've accounted for loan repayments, your tax, and actually living your lifestyle, how much you need out of the business, if you haven't got enough money there, then the deal's not going to work. The real cash flow of the business is what's left after those costs. That's what's going to fund your lifestyle. And that's ultimately what the bank will be interested in when they determine the sort of affordability of a practice. Is there enough cash left over to cover the bank repayments and your living costs and your tax? And it's worthwhile remembering as well, there's a bit of an average, when a lender looks at debt service ratio, they generally look to make sure you can at least repay the loans 1.25 times over. So after you've had your sort of drawings out of the business to live your lifestyle, and after the loan repayments as well. So they're looking for a little bit extra there, just to make sure, if things were squeezed a little bit, the business would still have enough to service that debt. But cash flow forecasts, again, are key. A lot of the time, the banks will look for these, and they'll be asked for these when they're looking for funding. And it's not looking at cash flow historically. Cash flow forecast, as a name suggests with the word forecast, is looking forward. It's sort of looking at what's the practice going to look like once you take over. So looking at what the performance will look like. Are you simply going to go in and take over the existing principal? Quite common, the existing principal will look to stay on for maybe 12 months. And that is good practice as well, because quite commonly the patients will feel comfortable with the previous owner. They'll know them. They may have been a patient there for a long time. Therefore, a bit of generic advice really would be to kind of make sure you get a bit of a tie-in from the existing owner if they have good relationships with the patients. It just softens that handing over process to yourselves as the new owner. But going forward, looking at the performance of the practice, looking at the staffing of the practice. So again, you're going to come into the practice as a new owner. Are you replacing what an associate was doing? Are you looking to bring in specialist fees, specialist work? Are you looking to increase turnover? I speak to clients quite regularly who look to say, okay, I'm buying this practice pretty much for the location, the potential. And again, that's fine. But I always say as well, you're not paying for potential, you're paying for what's happened historically. You're going to generate the potential by things like marketing. If there wasn't much expense previously for marketing and you're looking to really grow the practice, you're going to have to account in your cash flow forecast for extra marketing costs, maybe extra staffing costs if you need, and going to replace people as well while they're there. So just being clear on these kind of extra costs you might have to bring into these forecasts. And again, this is something at DJH we do a lot with clients, so please do reach out and we can help you with these forecasts. A lot of the banks we work alongside anyway, so they're quite familiar with our name and they're quite comfortable with kind of the forecast we give them because they know we are experts in our field as well. I probably touched on this a little bit already, but them non-EBITDA costs as well. Okay, the profit's one thing, but actually what cash is available once you've paid your loans back, once you've covered your tax liability and you've just took the money out of the business. I do occasionally see sometimes where when we actually sit down and look at these cash flow forecasts, that the owner can actually be worse off than they were as an associate. Associate dentists these days are making really good money. And, there's a lot less stress by being an associate than being a practice owner. But that being said, this is, practice ownership is building something for the future. You're building something tangible that you'll one day sell, but hopefully a nice profit and a nice gain as the practice profitability grows and increases over the years as well. So make sure you are considering these things. And ultimately, after we have looked at these things, are the cash flow figures net positive? Is there still money there to be able to kind of run the business? I think think that takes us quite nicely onto actually the financing of the practice now. As I said, one thing lenders generally look for from the cash side of things is 1.25, what they call a debt service ratio. So after everything's gone out, is there at least 1.25 times the available cash to repay that debt? Just to give them a bit of peace of mind, a bit of a stress test. Generally speaking, funders will look to lend probably 90% for the goodwill. Some lenders will do more now as well. The market has really opened up over the last few years, sort of since COVID really. There was a bit of sort of smaller sort of funders in the market over the last couple of years. A lot of the big businesses, a lot of the big banks and the small lenders have took a real interest in the healthcare sector, particularly dentistry. So historically, you may only got funded with 90% of the goodwill. Sometimes they might want a little bit more if the practice is a little bit more. Some of the figures aren't quite as clear. They may only offer 80% funding for the goodwill. Most lenders will look at 100% for the freehold property though. And yeah, the reason for that really is clear that obviously the goodwill is an intangible thing that you can't, you haven't got a physical hold of. A freehold property, they feel much more confident with something, bricks and mortar. It's something physical, it's something tangible. So they will generally look to lend for 100% of the value of the freehold property. We're sometimes seeing now as well, some funders looking to kind of merge the two together and offer sort of joint funding. The goodwill historically was usually funded over 15 years, the freehold over 20 years. Sometimes some lenders now will look to combine the two and potentially looking to do the two over 20 years, which will obviously help in terms of lowering your monthly repayments. If the term is going to be spread from 15 to 20 years, the monthly payments will go down a little bit. So it can help from a cash flow point of view. There are costs to be aware of as well up front. So there's certain legal fees, as Hugh's kind of touched on already. There may be fees with CQC and other things like that that may need to be paid personally. I've been in a situation recently where we set a new company up for a client with the intention of buying a dental practice. And it was two business partners. And it was agreed on day one, effectively, that they would both put an amount in the pot from day one to cover these costs initially. And obviously, you need to be aware as well, these upfront costs, if the sale doesn't complete and doesn't go through, there's probably no way of recovering them costs. So they are kind of sunk costs. So it's important to kind of be aware of that when you are making that commitment, really. As I said there, with company money as well, if you are a company entity already and you have raised that deposit in your company, you will probably be looking to fund that via your limited company. The obvious advantage there is that you have saved the tax over the years by keeping the money inside the limited company. The company can use its own funds to go and make the purchase. Therefore, you're not having to withdraw funds out of the company and suffer a tax burden by doing so. So, where possible, if you've got them funds inside a limited company already, it's strongly advisable generically to make sure that you're using them funds kept within the company to make the practice acquisition. Otherwise, if you're taking a deposit out of a limited company into your personal name to buy the practice personally, you will be taking a hit on the tax because once that money comes out of your limited company, it will become taxable income. As I mentioned before as well, there is strong competition in the market. So do kind of shop around a little bit and speak to different lenders. We do at DGH have our own commercial funding team who are impartial as well. So they will go to different lenders and try and find the best deal for our clients or potential clients. And they've done a lot of deals with us in the dental sector over the last few years as well. So they are very versed in knowing the sort of nuances of the market. And they can help as well alongside ourselves with forecasts and things like that. So we have got a good team there if anyone needs any help there. Looking at kind of the numbers a little bit, as I said, I'm not a commercial finance guy, but if you're looking kind of at financial rates at the moment, I think you're probably generally looking 2 to 2.5% above base rates, which is kind of where the market kind of is at the moment as well. And once that kind of commercial funding's in place, you've agreed a price on the purchase, you've appointed a solicitor, The next step really is to kind of look at the kind of due diligence side, and Hughie's going to talk about the legal due diligence in a minute. But I'm just going to talk a little bit about the kind of importance of the financial due diligence side as well. So what do I mean by financial due diligence? Well, effectively, we're trying to validate things like the turnover to make sure that it hasn't been artificially inflated. Ultimately, the price you're paying for the practice is going to be driven by that turnover figure, that top line. So it's important to make sure that we are validating that turnover hasn't been artificially increased. Looking at that NHS private mix as well and making sure that, okay, the practice holds an NHS contract worth X amount. We expect that really to be reflected in the financials. If there's any discrepancies there, what was the reason for that? Was there a failure to perform the number of UDAs historically and there's been a clawback? Is that something we need to is that a red flag in terms of, is there a recruitment issue? Is there a bigger issue there that we need to be looking at? We can also look at things like sort of benchmarking as well. So we can look at the NASDAQ stats and kind of look at them and apply them to kind of the deal and kind of go, okay, as I mentioned before, looking at the kind of valuation side, apply a similar basis and kind of say, we've got kind of the NASDAQ stats for things like staff costs, dental materials, lab fees, etc. Are they in line with what we would expect for a practice of that size? And this due diligence as well, I think, is more important on a share sale. As I mentioned earlier, on a share sale, you are buying the business, you are inheriting the shares and the history to it as well. Exactly that was said a minute ago. What are we protecting against? We're protecting against any kind of hidden liabilities that may crop up later on with overstated performance, or have they breached anything like sort of employment allowance? They claimed something they shouldn't have claimed, and you could be stung for it later on. It's making sure we're aware of it, and ultimately, we can add things into the legal documents to protect against this, which I'm sure Hughie will touch on in the next section.
Thank you, Matt. So yeah, moving on to the legal due diligence, then a big section of the questions that we would raise on behalf of a buyer is things to do with equipment and contracts. And as Matt has said, one of the biggest outlays is not only the goodwill, but the equipment. Now, it's not just the cost of the equipment. Consider the downtime if one of the surgeries were kind of like couldn't, use any of the equipment, or if something went wrong in the decontamination room, the downtime of one surgery can be a significant hit. Now, it takes ages for a seller to gather the information. In the olden days, you'd have like 5 lever arch files for a 2-surgery practice. These days, it's all done digitally, and I can't even tell you like how many gigs of memory like we go through. It's just crazy. But it is the seller's obligation to gather this information. So if the seller does want to sell, then it's up to them to get that. And it's your prerogative as a buyer to say, well, hang on, no, I'm not going to forego that because my solicitors told me it's really important to pursue it. But equally, though, it's important to take a pragmatic approach to it. So, some buyers may say, well, why am I chasing up a PAT test? It only costs like, a couple of £100 to get the whole place PAT tested. Just leave that point. I'll deal with it after completion. But there are some things that you cannot let go, and I'll come on to those later. So what are we reviewing then? Inspection certificates for all of the equipment, supply contracts for, things like the waste collection, your software of excellence, software, your website, lead generators, if you're doing a lot of private work. And we're also looking for things like related party or contracts that are not at arm's length. So these are things like Invisalign, for example. Invisalign introduced tiered pricing and an incentive model. So if the seller happens to be, for example, a Diamond Apex provider, they get a really good rate on their Invisalign, on the lab fees and everything like that. So, but you coming in, you might not be. So you're not going to get the better deals unless you keep the seller, for example, on as an associate. Other things we've come across, like the corporate bodies. So we saw Bupa perhaps shedding some of their practices, or even some of the smaller, medium-sized body corporates selling some of their lower performing practices. They have incredible buying power. So what they have negotiated with their suppliers aren't necessarily what you're going to be able to get as well. So we look out for any contracts that are done not at arm's length. I've also come across things like, the mate down the road is dealing with my software maintenance or, help in some way with the practice. Again, that type of thing, you need to rip that out. You need to get rid of those and say, look, I'm not taking on that contract. I don't know what's in there. I don't know what's been agreed verbally. Okay. With the practice compliance as well, then, look for gaps in compliance and servicing, because not only do you need to make sure that, you're paying for what you're getting, you're not going to have any downtime unless you actually go, I've looked around, I know it's shabby, my intention is to rip it all out and refit it. The compliance side is really important as well, because the seller needs to make sure that from a CQC perspective, the services that they are providing are not in breach of, the key lines that the CQC come in and inspect. So if you're taking over a practice with any issues in compliance, then that's, a real red flag, and a poorly run practice is what you're going to be taking over, particularly if you're buying the shares. And as Matt has said, you're taking over, the liabilities and the risks of that company ongoing. So you need to make sure that all of that is checked carefully for you, so you know what you're getting yourself into. Ultimately, though, you will be given the opportunity to say if there are any contracts that you don't want. And if there are some contracts that you don't want, it's just as simple as saying, well, no, this is a contract that you've negotiated, particularly under an asset deal, and make it the seller's obligation to terminate that contract and also pay for any termination costs. So, a lot of sellers will run their practices and not even review contracts and just quite happily pay every single year the increase and not shop around for a good deal. As a buyer, it's great for you then to be able to come in and go, well, that's your burden, that's your obligation. You discharge that, you get rid of that contract. I've negotiated this great rate, and this is what I'm going to be paying in the future. Staff and compliance is a huge one as well. So what we're looking for through here are the HR files for the employees. So things like the contracts, so you know what you're having to offer, because you are going to be taking on those employees under TUPE, which is the Transfer of Undertaking Protection of Employees. You can't just sack the lot of them and get your own employees with new contracts. You have to take them over. We're looking for things like ID, vaccination records, certification, training. Right to work is coming up a lot, because the Home Office are taking a very strong stance for any overseas workers, and you will be subject to really, really terrible fines and criminal prosecution if you do not carry out the correct right to check works. It's not okay just to rely on the seller. We do pursue the seller to make sure that they do have it, and if they don't, we say, well, get it now before we take over. Ongoing, as a buyer, it's your responsibility to make sure those checks are maintained. Sponsor licenses, if the seller is taking on overseas workers, make sure that they have the correct sponsor license. And we talked about this issue about legal entities. So Dr. Matt Norton might have a sponsor license, but actually he operates under Matt Norton Limited. That doesn't. That is actually in breach. You may think it's the one and the same person, but from a legal perspective, they are different legal entities. And that could subject the practice to a huge fine as well. We also look for any claims that have been made by employees, so we can protect you against that and make sure that the claims don't follow onto you, unless, of course, it is a share purchase, because you're taking over the risks and liabilities of the company. The only way you're going to be able to protect that if you do your investigations and you get something in the contract to protect you. Okay. On associates then, associates are self-employed, as you may know, being perhaps your associates yourselves. And we look up for all of the above, so the contracts, the vaccination certificate and all of that as well, but also restrictive covenants. So if you're buying this business, is there a risk, and I've seen this happen before, of the associates going, well, I'm not happy working for a new person, I'm going to go down the road, I've built up a great deal of goodwill with my own patients, and I'm going to take them with me. So check the restrictive covenants. Again, something you might be familiar in your own associate agreements are retentions. So if the seller has held back a retention from the associate's pay, can that be taken over by you? So when you introduce your associate agreements, make sure that the retention is in there as well. Do they have correct insurance? Are there any complaints against those associates? And always remember that non-delegable duty of care. So you'll have heard of the Hughes and Rattan case, where a principal can't just throw their hands up and say, well, actually, I'm not responsible. That associate is self-employed. They were the one who was subject to a claim by a patient, and I'm not responsible. The principal, so in this case, the seller, cannot just wash their hands of it. They are still responsible to an extent. And if there are any claims, anything, any complaint like that, we make that stick onto the seller and protect you from it within the contract. We're also looking for compliance gaps in the due diligence as well. So CQC, is the seller correctly registered? Have there been any reports, any sanctions imposed that would put your investment at risk? Anything that you would need to resolve? The GDC, so any investigations on the actual seller or the team that, again, that we would need you to protect you from. And also the CQC, so has there been a breach of the contract? Has there been a clawback? Is the contract, which ultimately is going to be a lot of the goodwill value, is there a risk of that being taken away? Are there any unusual terms? And we still see, time limited NHS contracts, can that be resolved? So those are the types of things that we're looking for there. On the property side, there's a huge chunk of due diligence done on property. So we have standard what's CPSE inquiries, which are commercial property standard inquiries, and they go through everything, because as a buyer, it's up to you to make sure that you do all of the checks on the property. It's sold as seen. So things to look out for are, do they have the right planning status? So look, we're looking at use class E these days. And for old practices, they won't necessarily have that, because they will have just set it up out, gosh, I think I came across one a few months ago where it was still run from, a residential home's front room. They're few and far between, but we still come across those. The good news is that you can get a CLEUD, which is a Certificate of Lawful Existing Use or Development. And that's typically if the place has been used for 10 years with continuous use as a dental practice. So also check on any conditions on planning, limiting hours, for example. And what about if you have plans to do any renovations or any building works? You've got to make sure that you're allowed to do that. Listed or conservation status properties has massive restrictions what you can actually do on the property. And again, your solicitor will uncover all of this in their investigations into the property. One weird thing that I've come across is there anybody weird lurking within the property? So I found, the seller's stepson worked there as a dental lab technician, occupied with no license. And it was so difficult to get the guy out of there, because the relationship had turned so sour. In the end, the buyer pulled out of that transaction because it was impossible to turf the dental technician out in order to be able to then turn the room into another surgery, which was key to their business plan. Also look at any reporting to the bank. Now, the bank will have their own set of requirements to fulfill. And if the bank aren't happy with the information turned over, they will just say, we're not going to lend you the money. Any missing documents, for example, FRA, which is a fire risk assessment, they need to be carried out by a qualified person every 3 to 5 years. Fire risk assessments are notorious for causing delays in a transaction. It may be something as simple as the wrong fire door being fitted, but by the time it's discovered through a new fire risk assessment being issued to the seller trying to find a contractor to do it, you're talking about, a month, maybe 2 months, and the bank just simply will not release the funds until they're happy with everything. Other things to look out for are electrical installation condition reports. So they're done every 5 years. And this is to do with the wiring of the property. Again, something that can be very, very costly if it's not done, which is why, again, if you're looking for bank funding, the bank won't issue it unless you can produce a good report. Gas safety, if there's any gas used on the in the property. Asbestos reports, which are applied to buildings with materials used pre-2000. So if you're buying a relatively new build or you're occupying a relatively new build, you're actually okay. Pre-2000, you're looking for an asbestos report. So if you have plans to grow and build, then issues with planning, issues with listed building, or actually being able to develop the property can cause restrictions. If you breach any planning, or if the seller has breached any planning, then it can result in enforcement action. And if it's occupied under a lease, the landlord can actually terminate the lease because of it's been a breach of the lease. The good news on the property, on the compliance, on the staff, and on the equipment is that we can always find solutions, whether it's a price chip, whether we buy insurance for any property issues, whether we can just say, actually, you know what, we'll deal with this. It's not such a big issue. The PAT test, for example, it's not such a big issue to hold the transaction up. Let's just forget it. So long as it's just you making the decision, that's fine. If the bank say no, then you've got to satisfy the bank. So combine this with how we would protect you in the contract. If there is a known risk, for example, an employee is suing the seller for a breach of their contract, they were perhaps harassed, they were fired unjustly, then we write into the contract that the seller will indemnify and protect you from any of that risk. But we will only know of that risk if the due diligence is carried out correctly. So back to instructing expert solicitors, make sure your solicitors know what they're doing so they can write into the contract how they're going to protect you. So CQC and registration and timescales. Now, timescales has cropped up in one of the questions about how long is a piece of string. There are things that can affect the average timescale of a transaction, such as the seller being slow, such as the DBS checks and things not showing up in order for you to be able to apply for a CQC registration. So going to CQC registration, it's crucial because it's one of those, without the certificate, without sign off, you will not be able to own a dental practice. The bank will not lend to you. The seller would unlikely sell to you. Be clear on the structure on how you trade, because that differs on how you then register. So sole trader is an individual, partnership is a partnership, limited company or any other interesting thing, so limited liability partnership, for example, is going to be under an organisation. You will require a DBS check. So unless you have an enhanced DBS check as a certificate, and some of you may have your annual renewals without a certificate, they will not be accepted by the CQC because you have to actually post in your certificate. The way around it is just by jumping through the hoops that the CQC impose and get a CQC countersigned enhanced DBS check. It can take a long time to get those. So the CQC is saying allow up to 60 days just for one of a CQC countersigned one. If you are requiring an NHS practice, there is an NHS partnership that is set up temporarily. So the seller will enter into a temporary partnership with you. Following completion, the seller will retire and the NHS contract will stay with you. And the CQC registration has to reflect that, going from individual registration to partnership registration, which requires a registered manager. And then following completion, that being dissolved and then a new registration being put in. So it is an absolute nightmare. Speak to your legal teams, speak to your advisors who will be able to guide you through that process. So timescales for that: DBS allow 2 to 6 weeks for your regular DBS check. If it's a CQC countersigned, as I said, it's 60 days. CQC registration timescales is 12 to 16 weeks. Build that into your transaction timescales. Now, CQC registration is mandatory. It can cause delays and refusals. If there is a requirement for a registered manager, if you're registering in partnership or an organisation, consider if the existing registered manager is going to stay. So, for example, a practice manager. Now, the problem there being is you have no control over that practice manager if they decide to have an extended leave of absence of 28 days. If they decide that they're not happy and they walk out, if they're ill, something happens to them. Operating without a registered manager where there is a legal requirement to have one is a breach of the regulations, and the CQC can impose sanctions if they feel that you've not put the proper plans in place to operate without one. So now I am aware that we've reached 7:30. So Matt and Tom, is everybody just happy just to go along as long as we can? The session will be recorded, so we will send the link to everybody. And I know that there's some people who have dropped questions in the Q&A box, which we will respond separately. We will make sure you get those answers to those questions that you've raised. But we're already running short of time, so we'll deal with those after the session. So negotiations, the contracts are the key documents for the transaction. Okay, so the negotiations is where we actually put the flesh onto the bones of the heads of terms, which is the skeleton that we talked about right at the outset. Be clear on whether it's going to be an asset purchase agreement or a share purchase agreement, because they differ greatly. Okay, the key difference is an asset deal is that you can agree on what you're acquiring, the goodwill, the equipment, the contracts, and you leave behind the unwanted liabilities. A share purchase, you're buying everything. You're buying the limited company with ongoing risks and liabilities. So within the contract, your solicitor can carve out those risks and liabilities where you are buying a share purchase. So don't think that, oh gosh, I have no choice. There are protections that we can put in if we know about those issues. Within the agreement, there are some bog standard parts, such as an inventory of what's included and excluded, the mechanism of the sale and purchase, what happens, how the money's paid over, and the pragmatic nature of the transaction. If there's an NHS contract, how you as the buyer will be protected against any clawback, how underperformance will be dealt with on the day of completion. A solicitor or your advisory team that doesn't know anything about dental practices will not know. They just simply will not know how to deal with those. And I've come across countless agreements drafted by a high street firm with no dental expertise that doesn't even touch upon dental work in progress. Apportionment of work in progress is really, really important, because if there are what we call big ticket items, and they tend to be things like implant work or orthodontic work, Invisalign work that also takes place over a long period of time. They tend to be the open courses of treatment that are still ongoing on completion, and figuring out the mechanism of how they are going to be apportioned between the buyer and the seller is something that will only come with expertise in an area of dental practice sales and completions. Particularly where, for example, there's a lot of Invisalign or a lot of aligner orthodontics. Depending on how the practice operates, is a chunk paid up front? Are the payments then spread out equally within the course of the treatment? Those are things that your lawyer will find out, and they will also provide for within the agreement to make sure that you're paid the correct chunk when you take over any of those open courses. Restrictive covenants are a key point. So you're spending all of this money to buy this business. The last thing you want is for the seller to then set up down the road and take their patient base, take their employees, take the team with them. Without knowing what you're doing, you can't just do a blanket ban and say, no, you can never work again, because if they ever came into a court and was argued against, a court would find in favor of a seller if those restrictions were drafted poorly. Deferred consideration, that's something I touched upon at the outset when we talked about the heads of terms. Are you actually going to hold back a portion of the purchase price on the basis of the seller staying on and working and hitting certain targets? The deferred consideration is a whole schedule within the agreement. And again, if your solicitor doesn't know what they're writing into there, that can really leave you open to risk and having to pay out when you don't want to, or if targets haven't been reached. How employees will be transferred and the protection offered against you if there's been any claims is included in there. The contracts and warranties There's a huge schedule just on warranties, and these are they act like promises that the seller are giving you about the state of their business. Now, if the seller can't give over any of those promises or breaks any of those promises, then you can sue the seller for that breach. But warranties are time limited, and they normally have a de minimis figure attached to them, which means you can't just claim frivolously for any type of claim. So, and usually an individual claim will have to be over £1,000. So you couldn't claim for a breach of the warranties that was only like 50 quid. Okay. And usually they have to accumulate till it reaches about £10,000. Those de minimis figures are negotiated on, but it means it just stops you from just claiming on every single frivolous claim. And it's also time limited, so you can't claim forever. It's usually between 18 and 24 months for a warranty claim. The difference is indemnity claim, and they go further to protect you. And that's a £1 a pound promise to protect the buyer against any claims or risk against you. So again, using that example of the seller being sued by an employee, if that claim lands successful, then the seller will protect you on a pound for pound basis. So that risk will be removed from you. Okay. It also sets out practical considerations on the day, what's handed over, the use of the name, perhaps following completion. You know, Dr. Matt Norton, when he sells his practice to Dr. Tom Slevin, isn't necessarily going to want his name attached to a business that he's sold. So the pragmatics of that is also included within the sale contract. Now, the disclosure letter is where the seller's protection sits for a breach of warranty. Again, it stops you from having to, it stops you from just claiming on really frivolous little willy-nilly claims. If the seller tells you why they can't give a warranty, or if a warranty has already been breached, and then you decide to still go on with the transaction, you can't then sue the seller for a breach of that warranty because they've already told you the reason for it. Now, once you know about it, if the risk is great, you can always go back to the negotiating table and say, actually, I want a price chip. But more importantly, is the risk so great to you that actually you want an indemnity for it? And that's something that crops up quite a lot when we go through this transaction and find things about the practice, because you're going in blind. It's our job to do that investigation for you. The property contract sets out how you're going to buy the property. So if you are buying the property, this is a really standard contract, but make sure there that you are aware of what you're buying. You have carried out all of your searches and inquiries, and you're satisfied with that, because it very much is buyer beware. It's sold as seen when it comes to property. If you do turn up anything, and I keep on saying price chip, but acting for the buyer, I'm always after getting more bang for your buck, or getting exactly what you want from this. If anything does turn up in your investigations, you know, works need doing, don't be afraid to go back to the negotiating table and say, well, actually, no, I want the price to correctly reflect what I've actually uncovered now. The lease is a completely different document. So sometimes you'll be just granted a lease of the property. It means that you don't own the property, but you'll be renting it. So check in the lease carefully if it reflects everything that's been agreed. The term is usually 15 years if you are looking to get a bank loan. Check other terms of the lease. So things like your occupation rights, so the right to assign the lease. What happens if 5 years down the line you decide that you want to move to Australia? Because, you know, who doesn't want to move to Australia? Quite frankly, it's much nicer than the UK for weather. And you know, and you want to be rid of the lease. Do you actually have a right to transfer that lease? And if so, on what terms? What about insurance and decorating and the upkeep of the property? Who's going to be responsible for that? More often than not, the landlord will make you responsible for it. And if you're not leasing the whole of the property, sometimes perhaps it's just the ground floor on a shop front setting. What service charge provisions are there? You know, what happens if there's a leak from the upstairs tenanted property? You know, who's in charge of sorting all of that out? Who claims on the insurance? Make sure you know how that's reflected within the lease. And finally, the associate agreement. Now, if you are keeping on the seller as an associate, make sure that the terms are correct for you, that, are there targets that the seller needs to hit? Make sure it's recorded in there. Are there any restrictive covenants that you need in there to match the sale agreement? Check that it's reflected in there. And a key point is make sure you try and get the associate agreement agreed ahead of exchange of contracts, because once you've exchanged contracts, you lose a lot of your negotiating power. So some takeaways from that is always be pragmatic and commercial. Try and get an idea of the cost and of the risk of each point of those negotiations, because it might not actually be worth the time and effort to negotiate those points to the minutiae. And don't overlook the emotional burden of negotiating those. I mean, I've known sellers and buyers lose sleep over the tiniest points, where in the longer scheme, in the greater scheme of things, it doesn't actually matter. Just check that, if it is a key point, that you do stick to it and you do protect yourself against it, but also use some points as a bargaining tool. Choose your battles wisely there. Oof. Oh, it's not moving now. So we've agreed all of those. Oh, so back to Tom then for some more points.
So just very quickly on completion accounts. So this just applies to purchase of shares. So if you're buying assets, you're buying the goodwill and equipment, this doesn't apply. And this is something that we see crop up in a lot of deals, and either one of the sides doesn't understand what they are. And so when you're buying shares in a company, you're generally buying it where you're agreeing it's going to be on a nil asset basis. So the cash and the assets equal the liabilities. But to calculate those, you need to prepare a set of accounts. So usually the seller and their accountants will prepare a set of completion accounts, which will be the profit and loss up to the date of sale. But it will also include the balance sheet. And from the balance sheet, you then need to work out what the net asset value is. So the net asset value generally is the current asset. So it might include stock, but that's some of it needs to be negotiated. It'll be debtors. So do the NHS owe you money? Do patients owe money? Plus the bank balance. And then you then deduct all of the creditors of the business. And so it's up to the sellers and the buyers to agree on all of those items. Completion accounts won't necessarily go to company's house. If it's not matched with the year end of the company, then completion accounts will be separate. And where you can get issues here is where either side doesn't understand this. If net assets are positive, so there's more assets than there are liabilities, then a payment will need to be made to the seller. And so the buyer will need to use the assets of the company to pay out that to the seller. And so if you've got a large bank balance when you buy it, that doesn't necessarily mean that's there for you to spend. But there's also the opposite, where the net asset value is negative, and so liabilities are more than assets. In that case, the seller then needs to put money back into the company to cover those liabilities. But there's loads and loads of things to look at on completion accounts. You need to look at the NHS contract. So are the patient charges that are being deducted after completion? What's the performance? Have they underperformed? Have they overperformed? As I said before, is stock being included or is it not? That's something that needs to be negotiated beforehand. With the NHS, you also have to have a look at like the rate reimbursements and stuff like that. But the major issue really comes down to liabilities and making sure that all the creditors of the business have been included in those completion accounts. And it's not until those are agreed that the NAV can be calculated and any payment made to or from the buyer and seller. As I say, this is an issue that comes up in all share purchases, but many parties don't actually understand what they are and the importance of them. And so if you understand from the outset, you can get those agreed early on, and you're not scrambling around the week before the completion date trying to agree what actually goes in those completion accounts. And so I'll pass you quickly back over to Hewitt.
Okay, so exchange of contracts is the point where all of the transaction documents have been agreed, and it is a key point for both the buyer and the seller. So it's the deal readiness stage. The due diligence is completed, the bank has given their approval, and don't be pushed to exchange contracts before you've got bank approval if you are dependent on a loan. The risk is that if you do, you've legally tied yourself into a deal that come the day that you have to complete, the bank may have withdrawn their offer, or the bank may say, actually, we're not satisfied with certain points and we need more time to try and get those points resolved before we actually give you the money. You will be charged interest on any monies owing to the seller at that point. So it's absolutely key that you get bank approval, what's called safe to lend, prior to exchange of contracts. So once all the documents are agreed, they are circulated amongst parties for signing. And oh, let me just go. And on the day of exchange of contracts, there will be some practical points to consider. So do you need to have a deposit on exchange of contracts? That can range from 5% to 10%. And if you do require payment of, if you do have to pay a deposit, that money has to come from you. So Matt touched earlier on about how are you funding the practice. If the deposit has to come from you, as a solicitor, we are under so many regulations to do source of funds checks, and it's, we know the bank of mum and dad is used. It's something that's quite common with a gift being given, but be prepared that we have to carry out source of funds checks on where these funds are coming from. So, don't be put out if your solicitor then asks for bank statements, asks to do ID checks on whoever's giving you a gift of funds, or asks for anything else like a letter confirming that it truly is a gift and none of it is repayable. A solicitor can't receive any of the funds in relation to a purchase prior to doing all of those checks, and it can take some time. So do let them know if the funds are coming from anywhere else other than you. So the timeline to consider between exchange and completion. Now, if you're buying a purely private practice, it's quite often that you don't have a split between exchange of contracts and completion. It's done all on the same day. A split between exchange and completion is quite often when there's an NHS contract, because there's a requirement to serve notice on the NHS of the seller's intention to bring in a partner. And the seller will quite often say, I'm not going to do this until I've got you tied into a contract, okay, on exchange of contracts. And that's when the notice is usually sent. Then there's a 28 days notice. It's usually a month, actually, because then the NHS needs some time to process the request and issue the contract variation notice. So we usually exchange contracts at the end of the month, because the NHS like changes to take place on the first day of the month, and that gives them sufficient time. Okay, so you've exchanged contracts. You're only compelled to complete then once the conditions are fulfilled. And the usual conditions that we see are the contract variation notice, so the NHS adding you, the buyer, onto the contract. The CQC position statement letter, also sometimes known as the comfort letter. Basically, that your application to be registered with the CQC has been processed. The assessors are happy with your application. Any interviews have been taken place. Any assessments of the building of the actual practice has taken place, and to all intents and purposes, the CQC assessor is happy to sign you off as a provider of regulated activities. So we get that through, and that's another condition fulfilled. Also consider whether you, as an associate, if you're currently working, do you need to give notice to your principal? Usually that's 3 months. A lot of sellers will refuse to sit there for 3 months in between exchange of contracts and completion. So factor that into your transaction timescales. Some buyers will take the risk and say, well, actually, this is key to me moving on with my career and developing. So I'm going to take the risk and serve and give notice on my associate agreement ahead of exchange of contracts. And yes, you don't know whether the deal is actually going to go ahead because you haven't exchanged contracts. There's no assurance, but that's a commercial decision that you have to make. And I know a lot of buyers who have then gone to actually work for the seller if the seller will allow it, or locum in the area close by, just to ensure that they still have some income during those months. Also consider the seller's requirements. Now, even where it's a private practice and you could exchange and complete on the same day, some sellers have this emotional attachment to their business, which, you can't fault them for it. They've built it up from scratch. They've been with the patients and with the team for years and years. It's almost like a family. And don't overlook that emotional attachment that the sellers want, because they can say, well, actually, no, these are my terms. I really want this period between exchange and completion. And it can be anything from, 2 weeks to a month. So completion, on the day of completion, what actually happens? Well, I have to say, it is actually a huge anticlimax. So you've exchanged contracts, and all that happens on the day, and it's not, I don't know whether you've watched any legal programs. It's not this huge gathering in a boardroom with like executives in suits or anything. It literally is just a set of phone calls to each other. So the bank will send your solicitor the funds, and the solicitor will then pay it to the seller's solicitor to hold. They can't just release the funds. They have to hold it until a completion call has taken place. And it all culminates in either a call or a Teams meeting, and you don't actually have to be in on it. There's very, very, very rarely the seller and the buyer are actually in on the completion call. It's just an administrative task completed by the solicitors. Do make yourself available on the day, though, because the number of times last minute things have propped up on the day of completion, I cannot tell you. And it's absolutely imperative that we're able to reach you just to iron out any issues before we complete. When we actually do complete, it's a phone call, as I said, but it differs in the analogy that Matt gave of buying and selling a house. It's much more involving than that. Make yourself available for a handover and make sure that the seller cooperates with you on a handover. Pragmatic things that you have to look through. So, who's got keys? Do you want to make sure that you gather up all the keys to then reissue it? Do you have all the login codes for all of the computers, the software, the social media accounts? Have you got the alarm codes? Do you know where the electricity and the water meters are? Have you done the utility readings? Get an introduction to the team as well, because you're going to be taking things forward with them and working with them. Also consider any of the other things that the parties need to do. So things like notifying the CQC. So on the day of completion, your solicitor will need to notify the CQC that completion has taken place, and the seller has to do the same thing as well. Thereafter, the certificate of registration will be issued to you. Also consider whether there's anything that you need to do post-completion with removing a seller, for example, from the NHS contract, or correcting CQC registrations if the seller is dropping away as a partner from your CQC registration. Then it's business as usual. It's down to you to run the business. But one of the things that I don't think is discussed enough, after having spent all of this time and invested all of your money, and you're now running this business, which is a huge commitment in itself, is what are you doing to protect your investment? And the sad thing is, I've worked with one too many families where the dentist has unexpectedly died, and there is this huge risk then that, are you going to be able to realize the value of the deceased's investment? So I don't really want to be a Debbie Downer about this, but I do talk about this now. DJH actually do have a private client team that can help you with things like writing a will, which I don't know, Matt, if you want to say anything else about what your team can do there.
Yeah, as you said, we have a team who specialise in wills and estate planning. So at that point in time, when you've made that massive investment of buying a practice, it's a great time to really review your kind of personal affairs with things like wills, insurances, and just kind of your personal affairs if the worst was to happen, really. As I said, we do have a team in-house at DGH, so we can help you with that when the time comes.
Yeah, yeah, and particularly where it's an NHS contract, you have a very small amount of time to be able to put plans in place to protect that contract, and sometimes the contract can be the bulk of your goodwill value as well. So you don't, what you really want to avoid is what we call a fire sale, where your family are just trying to sell what they can to try and realize some of the assets. And now there are things that you can put in place. For example, if you have a friend or a colleague who also have an NHS contract, get them on as a partner so that if one of you were to die, and they're only like holding 1%, it's just a paperwork exercise. It means that if one of you dies, that contract isn't automatically terminated after the 28-day period. Your friend or your colleague can hold that contract for slightly longer, and provided that you've got your will written and you've made a partnership agreement that ensures that they will hold that contract until such time as your family can find a buyer and they will help you with it, then it's a quid pro quo, and it's a win-win situation for both parties, I always feel. But again, it's just not something that dentists really talk about. They're so busy running their business. So yeah, sorry to be a Debbie Downer, but we're all going to die, aren't we? What did they say? Nothing more certain than death and taxes. And I know about death, and you guys know about taxes, so we're making a good team here. Let's have a look what else we got. So back to Matt.
Brilliant, Huey. Cheers. I'll try and lighten the mood slightly just to finish off a little bit there. But yeah, the last slide really is just looking at, obviously, completion's gone through. You're now the practice owner. It's a really exciting time. And I guess that you're going to be sort of stretched for time. But one thing is really important to do is after completion is to continue to monitor the performance of the business. Obviously, you've just took this big burden on, this financial commitments. You need to make sure that you are still doing bookkeeping and keeping sort of regular management accounts. That will just let you assess the performance of the practice since you've taken over. It may well be that at the start of the session we spoke about things like cash flow forecasts. If you've got that cash flow forecast and you've kind of been lent the money or a business plan based on X, Y, and Z happening, just keeping a track that actually what you said was going to happen is actually happening and is in place to make sure you're going to be where you need to be financially in 12, 18 months time and longer. Post-completion adjustments to consider as well, as Tom mentioned earlier with the net asset valuation, just to be clear on sort of cut-off dates and things like the NHS contract performance, work in progress, and sort of prepayment and the shared costs, particularly whereby you took over the business and you may have to be paying out certain amounts of money for costs that maybe were incurred by the previous owner, and just making sure everyone's clear on who owes what at the time of completion there. And that pretty much wraps things up, really. So I think I'm going to head back to Tom and he's going to go through some questions that have been asked.
Yeah, I think the main one that's left answered probably for Huey. So Kaylee's asked, if you're already the HIW registered manager, would you need to reapply to be the registered owner?
So HIW is a completely different thing from CQC, and it's not an area that I have a lot of expertise in. One of my colleagues has worked with HIW registrations. So if I could, I mean, Hayley, if you drop me an email, or I'm not sure whether you've ticked the box to share your data with Brabner's, what I can do is I can put you in touch with my colleague who can talk you through the process a little bit more.
Yeah, so your email's on the screen now, Huey, so Kaylee can contact you. And then there's one about swap practices, but if that person just gets in contact with any of us, we can go through a swap practice and what the process is.
Yeah, absolutely.
But so this has all been recorded, so the slides and the recording will all be sent to you. If you do have any questions or you want a phone call with any of us, our emails and phone numbers are all on the screen. So I'd just like to say thank you to everyone that's joined. If you do have anyone who you think would like to listen to it or watch the recording, then please let us know. We can send it on to them. But yeah, thanks everyone. Have a good evening.
Thank you.
Cheers, thanks for listening.
Bye.